Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we come to you and we bring you information about mortgages. Lots happening all the time in mortgages. If you want to hear the show, we're on a number of different radio stations. We're at KSHP in Las Vegas, Nevada, AM 1400. We're at K Tahoe up in the Tahoe area. And we're also in the Inland Empire at KCAA and at KMET. Yeah, did I get that one right? KMET, and also there's one more station, and it is, where is it?
K-Wine Country in Albuquerque, New Mexico.
Excellent, very much. Thank you very much. I'm a little discombobulated, and I'll tell you why, because in coming to the show, and this is typical of changing markets, and we've had a changing market now, probably for 60 to 90 days. I get a call from a client who is irate. They're irate because one of the co-borrowers who is also on the loan is trying to negotiate the deal, and they feel as if they're not involved in the process. The process really means what is the rate, what is the holdup, when can we expect to close? That's really what the information needs to be among all borrowers. Normally, in a situation where you have multiple borrowers, a borrower will contact us or the people who are doing the loan, and then they will disseminate the information. Now, in times where rates are rising, where there is no lock, where there is a contract on purchase or sale, whereby the date to get it closed is approaching fast, people get really upset and really want to know what's going on. Now, there's type A personalities who have to follow every inch of the transaction from A to Z. Normally, they're the people who are in charge and disseminate the information. However, you get two or three people like that, and they all want to be involved. So in order to be able to do that, the loan officer needs to spend extra time talking to all two or three borrowers. And when that happens, there are sometimes miscommunications because you don't talk to everybody the same way. You're not a robot. You're not speaking the exact same words to each and every borrower. So what happens today, I get called, borrowers quite upset just because, one, the loan hasn't closed, two, there is no direct contact, three, they are trying to contact, but as my explanation has said, contacting the person who is the contact for everybody in the group is what is happening. So I get a call like that probably once every 4 or 5, maybe 6 months that has happened. And in this type of market where we have falling real estate prices to an extent, even though, as we'll get to the news to use section, prices have really remained remarkably resilient. Even though we have less transactions, the amount that you have to spend on getting a property is actually rising in odd circumstance. But in those circumstances, like we're in now, rising interest rates, absolutely. Uncertainty in the economy, sure. There are, necessities and needs of people to be in control. And we are in out of control time, as will be evidenced very soon with our political voting, I guess, starts next week. Right, next week, Daryl? Is that what it is?
Yep.
Yeah, on Tuesday, right?
The midterms, yeah.
Okay, very good. So there's all that going on. There's the economic uncertainty. There's inflation, which is killing people in a lot of different places. Plus, you have the rising costs of fuel, mostly because the supply has been interrupted and disrupted since the war has started. All of this I'm going to cover in News to Use, but thanks very much for tuning in, for listening to the show. As I said, we try to bring you mortgage information and news. Top of my head, some of the news that's going to happen tomorrow. Now, you're going to hear this on Saturday and Sunday, so the Fed Open Market Committee meeting will have already happened, and the rates will be raising approximately 75 basis points. Now, that 75 basis points will be the fourth raise in a row, i.e., 3 percentage points above where they were at the beginning of the year. Now, what is the Fed rate? What is the Fed funds rate? How does it have to do, or what does it have to do with the mortgage rate? Well, they're not synchronistic, but they are tangential, meaning that one does affect the other in certain ways. And usually what it means is when the Fed raises its rate, which is short-term borrowing costs of interbank necessities, banks have to keep a certain amount of money in their vault on a daily basis. If they don't have it, they have to borrow it, and that's what the Fed funds rate is, basically. So it went from 0.25% up to, and it's now going to be about 4.25%, all within 11 months. That's pretty fast. That's about as fast as it's ever gone, and it's all been really calculated to get inflation under control. Now, inflation, again, is another aspect of what we're going to talk about, is one of the other pressures in the marketplace that really it's hard to quantify in terms of the real estate world, because the real estate prices have really been inflationary for, 3-4 years. Certainly during COVID, which is, about 3 years now, we've seen probably 20 to 25% increase in price of housing, both on the rental market as well as the sales market. And that's a big number, 25%. You think about that. You have a $100,000 house, it's now $125,000. You have a $200,000, it's $250,000. So go on up like that, and in most markets, $350,000 to $400,000. That's what you're going to have to spend to get a house. Now, in expensive markets, big cities, big markets, it's close to $1 million. I mean, I live in the Los Angeles area. Los Angeles County median price is about $900,000. Orange County, which is just south of LA County, is about $1,100,000. Even in San Bernardino, Riverside counties, and hello to everybody out there who listens to the show on a weekly, the prices out there are anywhere from $700,000 to $800,000 on a median price. Now, yes, you can get good deals and you can search around, but for your average buyer who's out there looking for a nice new home in a nice neighborhood, a good school system, that's what you're going to have to spend in those areas, and that's pretty expensive. So, yes, lots of things going on. All right, let's get to a couple of things in the news to use section. Pending home sales fell 10% in September. That's right, pending home sales, meaning sales that are under contract. You go into a escrow, what they call it. Pending sales down 10%, but prices are up. What are the prices are up? 11.4% year over year. This is what I'm saying. Now, there has been a drop in the amount of increase in the value of your home year over year. Last month it was 13%, so now it's down to 11%. So it's actually dropped 2%, but it's still up 11% year over year. Why is that? Supply and demand. Not enough houses, a lot of people still out there trying to buy. And why is that? Because we still have almost 11 million people who are needed for jobs that can't be filled, which puts pressure on employers when they're hiring in order to raise wages. Wage inflation is the number one cause for everything else going up. If you own a business, I don't care what size business, you've got to be able to attract good people. Whether you're the barista at Starbucks or whether you're the CFO of a major tech company, you are being recruited or you are being offered higher salaries now in order to keep you there because there's a shortage in the labor market. There's a shortage in the number of people who are out there in the marketplace. And that particular number went up this month. That's right. In October, the number of people looking for work has remained the same, but the number of jobs available has gone up from 11 million to 11.7 million. That's a big jump. You think about that when we're talking about maybe a recession, inflation is really too high, the economy is doing terrible. This is what's happening in most people's minds. Depends on what you look at. Remember, best way to get information on economics is to read it. You can't watch economics. You have to read indicators. Most indicators are following indicators. Forward indicators are things like the stock market. So if you see the stock market went up in the last week more than it's gone up since 70 in 1 week, you would say, that's a forward indicating marker, meaning that people in stock market think the economy is going to do well. Now, how far out is that further out look? How far out is that indicator? It's probably about 6 to 8 months out, I would say. But everything else is a backward-looking indicator. Listen, we're up against it. I'll see you next time in the next segment. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we come to you via several ways. One of the ways that we like to come to you is through the internet. If you go to themortgagevoice.com, that's our website. On that website, you're going to see guests of this show. They appear, and the way by which you can contact them. You can listen to a couple of the shows also that the guests are on. It's just a great way to stay in touch with us, the program. There are a lot of ways that you can follow the mortgage industry, but nothing is collected in an easy format like this is. All you have to do is go to the mortgagevoice.com and click on whatever the link is to be able to either connect or listen to. Very simple, themortgagevoice.com. I'm Jeff Barton. Thanks very much for tuning in, and this is The Mortgage Voice. Okay, so each and every week, as I say, we bring guests to the show, and Livier Becerra has been on the show many times, and she brings us perspective from the front lines of what's going on in the mortgage industry. She joins us now. Livier, how are you?
I'm good, Jeff. How are you?
I'm stressed. I'm stressed. I got to be honest with you. Business hasn't been like this for 12, 13 years. So it's an age-old problem in our business where we ride the tides. We're up, we're down. And satisfying mortgages and what people need to do and how they need to be helped. That's why I called you today. How are you handling it, and what are some of the ways by which you're, I guess, solving problems for people worried about rising interest rates?
Well, it's feast or famine at times. You're absolutely right, and it is stressful.
Right.
I think that this is probably one of the most stressful careers you could probably ever want to have or not have.
Right.
But it has very many pros, though, so that's why we stick with it.
Right.
But right now in the market, obviously we're all having the same problem. I think I read the mortgages were down 50%. I think
Yep.
it's more than that.
Well, my business is. I don't know about the nation, but I can tell you our business as a company is down, probably 60%.
Right. Refinances are pretty much, scarce. I mean, only if somebody, honestly, the only ones I've had are people who are divorcing and have to buy out a spouse, or something like
Right.
that, or
Right.
partner. So that being said, most of the loans are all purchases. And right now, I mean, they're in the 7% range.
Yep.
We had some increases today as well. I priced out today for a client who's doing a profit and loss statement loan, where they're self-employed and they have plenty of income, and just providing a profit and loss, they're able to qualify, and that was like 8.5%.
Right.
And which I mentioned to them, look at if you were to get a regular loan, you'd be 7.5. So actually, you're not at all bad off with that rate.
Right.
So problem solving. I mean, there's still loans out there for anybody. That nothing has gone away like it did with subprime before when they just disappeared. So there's still programs out there. A lot of different choices, different options.
Now, because you're with a brokerage company, you shop around to different lenders. Do you see that there's tightening as well as hiring rates going up, meaning that the actual qualification process is harder, or is it the same, or is it easier?
Honestly, I don't see that it's gotten worse. In some cases, non-QM, they've actually loosened it up a little bit.
That's good news.
For FICO scores and whatnot, they've been a little aggressive, which is good.
Right.
I'm just waiting for some lender to come up with a great idea where you can start assuming these 2.5% loans for somebody selling their house. That's what I'm waiting for.
That's so funny. When I first bought a house way back in the dark ages, assumption of loans was common.
Right.
It wasn't something, probably because of what you're saying. The rates at that time, of course, were, astronomical. So if someone had a rate, even with an 8% rate, was unbelievably low at that time. Yeah, you could assume it. Or you would do seller financing, which is like an AITD or some kind of land contract.
Right. But don't you have to have the property free and clear to do that, I believe?
I don't know. I think in order to do that, I don't know if you need the permission of the lender who has the lien on the property in order to do an AITD. I just remember doing them when I first got in the business back in, I guess, early 90s. Because there was a recession in 91 at the time, and so I think we were doing them then, but I don't know, I don't remember. You may be right, or the program may have changed to be only available to those who have a fully paid off loan. I don't know.
Right. I think so, because what if the seller stops making the mortgage and you're still paying them and you don't even know you're in foreclosure? I mean, I don't.
Yeah, that happened. That did happen. That you mentioned that. Yes, that did happen. I think right. The seller is still on the hook for the loan, so they're going to need your money in order to pay off that loan. So you go into a contract which says, okay, I will live here, and can you continue to pay off the loan? But the problem is the seller wouldn't pay off the loan, keep the money. I don't know. It made it confusing. There's no question.
Hence, easier if it's paid off. I mean, You're not going to go into foreclosure if you can still foreclose on them even though you're because you're not making a payment. So
right. They do seller carrybacks. That's also another way by which you can use a large concession or some kind of seller carryback in order to make the down payment less.
Absolutely.
Right.
Absolutely. So to avoid the mortgage insurance, if you want to put down 10% and they can carry 10%, and then you can just get an 80% loan. Absolutely.
Right, all of that. Name some of the other programs that you think might be helpful or things that you think are working in this particular market.
Well, right now you have a lot of actually self-employed borrowers who obviously, they make astronomical amount of money and then they write everything off, which a lot of their business expenses are living expenses. So really, those, even though they're allowed to write them off, they're really not and shouldn't be counted. But anyways, so they're, like today, the P&L loan, you have bank statement loans. If you have 12 months bank statements, 24 months bank statements, they could take all of your deposits, average them out anywhere from 50 to 90%, depending on what your occupation is or your business is, and that would be your income. I have clients who deposit $100,000 and they get to put $90,000 a month of their income as income. So or even if it's 50%, there you go, $50,000 a month. So that's still a very good one. You have your DSCR, which is for investors buying properties, and as long as the rents will pay the mortgage, and different lenders have different ratios. If 1 to 1.25% to meet the payment, then that's it. That's all you need to qualify if you're an investor. So those are great loans if you're looking to invest in properties, which is going to be coming around soon. If anything, we don't have to be genius to see that there's going to be some foreclosures coming our way.
You think so? I always get a feeling that the corporations swoop in, especially the bank's in trouble. They have, 40 houses that they have to get rid of. It's easier for them just to have one buyer come in, swoop in, buy them all, and then they keep them and rent them out. That's what happened the last time. And Bill Gates' company, right, or the company he's invested in, whatever they're called, they're doing the same thing now too, buying up single-family homes, keeping them, renting them out. Right.
That is very, very well possible, but same as like in 2008 when the bubble happened.
Right.
And I'm not saying that it's going to be as aggressive as that.
Right.
Obviously it's already dropped more than 20% the values, and all these people that bought very, very high, and if there's a recession, they're not going to be able to make those very, very high payments that they got from their loans.
Right.
So. And, obviously, anything that would help would be, if the assessors, like they did before, they reassessed the properties, lowered the tax rates. So
sure.
That will help some, but some of them won't be able to make their mortgages. So.
Yeah, I'm always skeptical that the housing, even in foreclosure, will get to the people who really need it. It's always the people who would make it expedient for those who just want to dump all the properties. Like the iBuying, all those properties, there were 18, 20,000 properties, and they all just were sold to corporations. And that wasn't,
Right.
what was that, 8, 9 months ago? It wasn't even that long ago. So I wish there was a way by which those things could bleed through, but it's not happening.
Right. Well, I mean, and again, hopefully it won't be such a big difference where they wouldn't be able to just do a short sale or be able to sell the property,
Right.
a little, some of their money out or at least break even.
Yeah, I agree. Hey, listen, we're up against it. I apologize. I just looked at the clock and I ran out of time. Sorry. Oh, jeez. Here's gabbing away. Livier, thanks very much for coming on the show as always.
Oh, no, it's my pleasure. Thank you for having me.
Thank you very much. That's Livier Becerra, and she works for Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week, we bring to you some of the best information that you can find out there about mortgages, whether it's a refi. Well, there's no refis right now, but when there were refis, we were the place to go to, certainly in the purchase market and certainly in finding a solution for your particular problem. I think people get caught up in the rates. They get caught up in, the economy. What is your particular situation? How are you approaching trying to get that property, and who are you working with in order to solve the problem? These are things that are really more specific to your situation, and I think if you're out there right now and you're looking for a house, that's the way you have to approach it. Anyway, I'm Jeff Barton. Thanks very much for tuning in. We bring Charles Giscombe back to the show once again because he's kind of got his nose to the grindstone as well as his feet on the ground, a lot of different grounds all over the country to kind of help us understand and navigate through what is, honestly, it's been a challenging market for a lot of borrowers. Charles, how are you?
Great, Jeff. Thanks for having me again.
Thank you very much for coming on. Okay, rate challenged is one thing. Program challenged is another. What's the biggest obstacle to helping people?
Well, first of all, you got to almost have to rework the mindset. Obviously, we go over this, and it's cyclical. We've gone through it before, and we will continue to go through this now and forever. And so it's mindset change. Some people believe going into a loan, and it's rate.
Right.
And then you go, okay, you're rate conscious. That's what you're. But now everyone has an issue with rates. It was easy for everybody to get into the market with the low interest rates. Everybody was selling them. Now, at the end of the day, you have to go, what are other things I can do to offset the high interest rates that are in the market for everyone right now?
Right.
And what you do is you find different terms. Now it's not about rate. Now it's about terms. It's about value-added services to the particular product and the guidelines that they have that now can facilitate a transaction for you, which may help you. At the end of the day, it might not be the lowest rate, but in some cases, you can be paying a lower monthly payment with a higher interest rate. And how that happens is the different programs that we at Malibu Funding try to look at. We're looking at other programs that will offset that high interest rate with maybe a longer amortization period. Instead of 30 years, maybe 40 years. Maybe you look into an interest-only program that will allow you to pay interest only with no penalty. If you're truly worried about what is the check that you write every month towards your bills, of whether you're in a, if you're financially you're in a set income situation, then these are some of the programs or things that you can look at that can help you if you believe initially that it's interest rate. Now there's some things that can get you lower. Also, these programs have no mortgage insurance. So other individuals that had lower interest rates were paying mortgage insurance. Some of these programs don't have mortgage insurance. So there's many different things and many different programs that you can look at that can be alternative choices and options that you can utilize instead of just a traditional rate mortgage with the low interest rate. Because like we said before, No one has a low interest rate out here right now, Jeff.
No, no one does. And I had a guest on earlier that was talking about assumption loans. Do you think we'll ever see those again?
Well, where you can assume a loan, I believe there's some loans that have the ability that are assumable.
Uh-huh.
You know, a lot of people went away from that because you just don't know. Sometimes, you know, you have a borrower, the bank gets to know that borrower, and now you have someone else coming in and they can qualify for the situation, but it's a little different. I haven't seen so many of them, but there are certain loans that do allow individuals to assume another loan.
Well, you know, we were talking, and they were saying, look, there are some solutions that are not yet really viable, and one of them was assumption. Now, for those people that don't know, the assumption of the loan is the seller has a particular rate, you'd like that rate, and you just assume their loan, take over the property, give them the difference, whatever that is, in the price, cash. So what are some of the other of the, I guess, creative ways by which you might be able to get into a property? I mean, you had mentioned several of them, certainly the DSCR, certainly bank statements, certainly profit and loss statements. What are some of the other solutions you might think of right now?
You know what, at the end of the day, there's a lot of different situations. I mean, I like to go the stated route.
Right.
You know, you can, and if it's investment properties and not your primary residence, there is a way that you can get into loans where, you know, I see a lot of people trying to get involved with seller carryback situations, seller financing loans, in which you can seller finance, and that person who has the mortgage can become the bank, and they can allow you to get in. Now, you have to make sure that you're very aware and knowledgeable about this, the different terms and the different things that occur in that loan. But that is a way also to get in. Someone may be wanting to get out of a property. You may be wanting to be able to get in. Interest rates may be so high. You and that individual set the price point and the rate and the payback terms, and that person becomes the bank and can seller finance that situation to you. You see that happen with a lot of people who are finished with their loan terms or finished with their loan terms trying to get into something else, or they just want to move on to another property but don't want the existing property to be, you know, not lived in or not rented or not sold. So a lot of people will turn to seller financing. There's many things that you can do, and that's one of the other creative ways I've seen individuals bring loans to the table. And they still want our assistance on structure, because at the end of the day, it's still a loan. It still has terms. You still have laws and things legally that you need to do and take care of and make sure that you're covered on. So that's another way, creative way, individuals are getting into properties as well.
Let's shift gears a little bit, talk about commercial. I know you're involved with some housing, house flipping, as well as some commercial loans. What is that market like? I mean, we talked a lot about residential most of the time on the show, but a lot of people are looking for investments right now, thinking that there's a possibility that commercial might be the way to go.
Jeff, you know me. I talked with you a lot about this. It was very important for me. During 2008, when the market crashed, we still had individuals who still had ATR, and in loan lingo, that is ability to repay, ATR, but they didn't have traditional structure. So they couldn't provide their tax returns. They didn't have W-2s or paycheck stubs. It was individuals that were self-employed. They were making money. You could see the money coming into their bank accounts. But at the end of the day, they just did not either have that structure, those taxes, the way they were done right, or didn't want to provide that information. Hence, all of our searching and research, looking for loans that said, if you have the ability to repay, we can get you in. It's not measured on your job. It's not measured on all the amount of money you have, but you do have to show the ability that you have the down payment and reserves. And there's programs that will allow you to get into a loan stated, like the old days, where basically you just state your income, and as long as you can provide a credit score, a minimum FICO score that will fulfill that requirement, you can have an LLC or an LLP, and you could qualify that way. Interesting enough, there are some of these loans that will allow you to get in, and they won't show up on your personal credit, so it won't be a liability. That is an awesome perk to a situation. A lot has evolved in those type of loans. So now they're offered at a 30-year clip, Jeff. You can get them at a 15-year clip. You could get, I have a program that we work with right now at Malibu Funding. We work a commercial loan that can give you a 30-year fix with a 10-year interest-only option.
Nice.
Individuals don't know what that means, is that you have a 30-year amortization. But in the event that the market does a twist the way we are in right now, then basically you can exercise a 10-year interest-only option with no penalty that allows you to pay interest only for 10 years just because when the market flips and the rates change and things change. That gives you some leeway, some flexibility to pay a lower payment so that you can weather the storm when this market is the way it is. Now, and then it also offers you an opportunity to refinance out that loan when the market gets better.
Great point, and great option for those type of borrowers. There's still a lot of cash in the market. I saw somewhere where 25% of some of these markets are still being bought all cash in the residential market. That's pretty amazing, isn't it?
It is amazing, Jeff, that we're still moving this way.
Yep.
I mean, there is some, we've been through this many times, so there is some hesitation, but there's also individuals that know that it will also change. So they're still aggressively out there making moves, making things happen. And the properties have leveled off a little bit, but they haven't gone down in value so much,
right?
Whereas that you're losing or you're upside down like we were in the crash. It's not that way. So now you still can be aggressive, obviously conservatively aggressive, if you can say that you can get out there and make sure that you can still find some properties of value, make some money doing renovations or buying investment properties, and have confidence in that.
Right, I totally agree with you. Listen, we're up against it. That's great and fast. I appreciate that, and I wish we had more time. But as I said, we're up against it. Charles, thanks very much for coming on the show.
Jeff, thanks for having me. Always love it. Malibu Funding, folks.
Thank you very much, and tell people how they can get in touch with you. That'd be great.
Not a problem. You can reach me at that good old Las Vegas number, 702-328-5191. That's 702-328-5191. Or you can reach me by email, charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Excellent. Thanks again, Charles. I appreciate you doing this once again.
Always, Jeff. Thank you.
Thank you. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. We bring to you information pertinent to your purchase or refinance, although I believe 85% of the people don't do refinances anymore, so that's not really a viable option unless you like to going from a 3% mortgage to an 8.5% mortgage or something such. All joking aside, if you want to see us, hear us, each and every week this show, you can also go to YouTube. Jeff Barton, The Mortgage Voice, is a show on YouTube. That's my channel. And if you go there, you can see and hear this show, last week's show, and hundreds of shows in the past that we've done in order to bring information to you. The information is here. It's easily accessible, and you can listen to it not only on your radio, but in your car and certainly on YouTube. So Jeff Barton, The Mortgage Voice on YouTube, that's the place to go. When you go there, click on you like it, you want to join, and just be one of the many that gets this information sent directly to them. Okay, so I am Jeff Barton. This is The Mortgage Voice. We bring back to the show Wendy Van Wessel, who's been on the show many times, and she's from Kind Lending, a great lender that Malibu Funding uses, and she joins us now. Wendy, how are you?
I'm just fine, Jeff. And yourself?
I'm fine, too. Talking off air, we were talking about the business and what's happening at Kind, like it's happening everywhere else. Some of the programs that you're offering in order to solve the puzzle or the mountain, which is on everybody's mind, which is the rate, right? The rate is high. Everybody knows it's high. How do we get people off rate and onto programs that might help them?
Well, I was just talking to somebody, and this is not for everybody, but they are doing non-owner occupied properties through the Airbnbs. Sometimes you could get up to 3 times what you'd get if you leased your property out.
Right.
You need to keep track of it. You need to have 12 months of consistent income when you're looking to qualify your non-owner occupied rental unit. You're looking at a 1-to-1 ratio for your principal and interest to what you're getting as far as income goes. You get a better rate than if it's under a 1-to-1 ratio. Mm-hmm. A lot of people are looking at that as far as investors go because Airbnb puts it directly into your bank account and keeps track of it for you. And then there's purchases. Purchases will always be there, right? People are always going to sell homes. The 2-to-1 buy down is getting seller paid 2-to-1 buy down is getting more popular again.
Right. Tell us about that. That's a very difficult program to explain if you just say 2-to-1 buy down. What does that actually mean?
Okay. So the first year, you're paying a payment that's 2% lower than what your actual rate is on your note. The second year is 1% lower than what is actually the note rate. So how that is done from the seller, there's a really easy calculator that we have, and I can send it to anybody that wants it. You put in the loan amount, you put in the rate, and then you put in what it would cost to buy it down, the 2% and then the 1%. And the seller pays that as part of an incentive to buy the home from them or the home that they're offering. And that wasn't available before when it was so much of a seller's market. As the FHA loans are becoming popular again, and we can start approvals for some.
You're kind of fading in and out. Are you speaking into the microphone?
I am.
Excellent.
The FHA loan is also very popular.
Right. Okay. No. I like FHA loans. I like that they're government insured. Certainly VA loans at 100%. That's also good. Now there are some extra fees with both of those loans, but fact is that the ability to get a loan at a lower down payment is a good idea. 100% financing is a good idea too.
To $2 million for the VA loans.
How much?
We go to $2 million on VA loans.
Oh, that's
and there's
outstanding.
something that was very interesting because I think a lot of vets were looking at 2, 3, and 4 units, and if they didn't have landlord experience, they couldn't do it. They wouldn't let them do it. We will let them do it if they get a management company to collect the first 12 months of rent. Any vet out there that wants to buy a 4-unit and take care of that property can, when they have at signing, they will hire a management company to collect the first 12 months rent.
Now, what's the thinking behind that?
Because they don't know if they know how to collect rent, how to keep it going. Without the experience, they're not sure. But they know at least the first 12 months there'll be a management company that is savvy in how to collect rents, maybe from people that don't want to pay properly.
Right. Well, with the rents the way they are, I mean, obviously, the rental properties out there that you want to buy are going to be rented pretty quickly if you buy right, and most of that is done right because you can't afford a DSCR unless you're buying a property that the rents can't afford the purchase price. So, if you can do that, it's a great market because there's still not enough rentals out there, and prices for rentals have really outstripped prices for mortgages. It's cheaper to buy a house than rent a house in a lot of markets.
Still, yes, it is. And then the debt ratio is really tough because if you were looking at what you were saying, 3% rates compared to where it's like, low 8s now, I think the average interest rate is. It's about $1,000 more, and often in $500,000-$600,000 homes, $1,000 more a month. Well, there goes your debt to income ratio.
Right.
So we have those non-QM programs that are quite popular now too, bank statements. For those people that wrote off too much on their taxes, if they can show that they have gross deposits of a certain amount to cover their if they cover their debts, then we can do it that way. We also have 1099 for those people that are self-employed. We can do just a 1099. We have asset depletion. If they have enough assets, they divide it by 84 and they're done proving their income. So there's options out there for the people.
No, that's
and
good.
Then next year they think the rates are going to go down to 5.25-ish is what MBA is saying, and then they can refinance. So you can get those purchases, you can get those properties, you can get that Airbnb history that you need for your DCR ratios. And by the way, we go under 70% too, and then refinance next year. So
hey, it's that you say that the rates are going to go down. That's interesting. So you're saying the Mortgage Brokers Association of America are putting that information out that, in their opinion, the rates will go down. Why do they say that?
Why they say it, I don't know, but I've heard it a few places now that they think that this year, next time, they should go down a little bit. But that doesn't mean that the purchase that you want, the property that you want, those deals that are out there are going to be there. Just know that there is light at the end of the tunnel, that there is, you can still, the real estate market has taken a big hit, especially in California, but there's still deals out there. There's still things to be done. And the loan officers, they're exploring that non-QM avenue where people might have written off too much. And I can help with any questions that you have. And I love that VA unit thing because the vets can have an income-producing property even if they don't have the history. And we called straight to Washington because all of that air centers were saying different things, and we had to get that real answer, and we got it with they are allowed if they use a management company for the first 12 months.
That's great information. What is the? I struggle with what's happening in the loan market, just simply because we rode this high of great real estate and mortgages for about 2.5 years, and now we see a concerted effort to really kill the market. Although demand is still high, but the affordability is less. Do you at Kind think that it's easier to get a loan? Rate aside, have they tightened restrictions at Fannie Mae and Freddie Mac as part of this overall desire to kill the real estate market?
I know that they're going for the underserved communities. That's a big issue with the government agencies. I haven't seen them get stricter.
Okay.
Maybe little things, but not necessarily huge program changes for Fannie and Freddie. But it's harder to qualify with the higher rates.
I see.
I think that. Do you think the rates are going to go up before the end of the year? I think we discussed this before. When the inflation rate is, what is it at now? 8.5%. Is the inflation rate at 8%?
Well, if you take out housing and you take out gas, it's about 4 or 5%. But those two things are you can't get rid of gas, and you can't get rid of a house. You got to live somewhere.
Yeah, so I think it's 8 or in the low 8s, and the interest rate is probably somewhere hovering high 7s, mid 7s. So they're going to probably. The feds are probably going to hike up the interest rate another 0.75, and they even said something about another 0.5 point before the end of the year. Because they need that interest rate to get higher than the inflation rate in order for a recession not to occur if we're not already in a recession right now.
All right. Well, I just always ask those questions about is it harder to get a loan today than it was last week? And my answer is always probably, just because, as you said, the rates go up. It's obviously going to be a debt-to-income ratio or a loan-to-value ratio. Anyway, Wendy, we're up against it. Sorry, go ahead.
I do have some good news because brokers and people are always worried about jumbo rates. We have a new program, and the rates for a jumbo loan over $1 million is 6.25%.
Wow.
For a 10-year ARM, and 6.5% for a 30-year fix. And I've been thrilled since last week that we have that program in there. So there are things out there. Just make sure you have a very strong loan officer that knows the best program for you to get the house of your dreams, and they're still out there.
Hey, Wendy, let people know how they get in touch with you if they want to contact you directly on some of these loans that you're talking about.
Sure. Wendy Van Wessel, phone number 818-292-2572, or wvanwessel@kindlending.com.
Wendy, thanks again. Once again, great information. Really appreciate you coming on the show, always with terrific information.
It's always a pleasure to talk to you. Thank you, Jeff.
Thank you. That's Wendy Van Wessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everyone. Welcome back. I am Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, we are on a number of podcasts. A lot of people who podcast nowadays who never podcast before started to come around to the medium. You know what a podcast really is? It's radio on your dime, meaning that you can listen anytime you want. Radio is something that you have to listen to on the radio schedule. All of the things that we're going to talk about, Daryl, do you have those up and ready to go?
Sure do, Jeff. It's,
Thank you.
Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and, of course, The Mortgage Voice.
Excellent. TheMortgageVoice.com is a terrific website as well, and Podclips.io, you can go there not only for my particular podcast, but there are a number of other great podcasters on that particular site, from finance to health to entertainment. There's all kinds of things there. So if you're sports too, if you're looking for a central location to find a lot of great podcasters, go there, podclips.io. Okay, so in talking about podcasts as being the new radio, basically anytime you want to hear great content, go to some of these places and look up Jeff Barton, the Mortgage Voice, and you can hear this show archived, many shows from over the years. Get a sort of a trend as to what's been happening, not only lately, but over the past few years. Sometimes I get people who call me or email me. Usually it's just a like, the way younger people are today. They don't really call, they don't really write, but they will give you a like on Facebook or Twitter or TikTok or any other of these particular social medias. So that's what happens. They say, I like it. And they'll watch 6-7 shows in a row, like them all. It's really pretty interesting that way. Okay, let's get back to it. I've been talking about a lot of stuff, really shouting at you, and I apologize for that. But sometimes it's the only way I can talk fast is to talk loud. So if you're there, just turn down the radio a little bit, and you can hear everything I'm saying. Most everything I'm saying is fact-based on all the research I've been doing and the experience that I've had in the business. Mortgage business is really down. Everybody knows that, right? So let's just talk a little bit about why that is. Let's see. I'm going to look for the one stat I wanted to quote here about the mortgage industry. Okay. When we talk about loans and the mortgage industry, now, real estate industry, mortgage industry is part of that. 1 in 9 people in America work in that industry. It's a big industry. A lot of people are affected by it, whether it's a escrow company, a title company, a home inspection company, notary republic, all these kind of different jobs that are involved in a real estate transaction. And what I talked about earlier in the show about an irate customer. All that is in the real estate sector, 1 in 9 people working in it. Okay. Per loan average of what we're making. That's a really big indicator as to the health of the market. Currently, we're making negative, that is, we're losing $82 per loan. This is on average of the lenders, major lenders in the U.S. To give you a perspective, a little bit of insight, when we were at the height of the COVID-related refi, when rates were 3%, remember? Oh, man, that was so long ago, 10 months ago. Okay, so when that was happening, we were making about 3.5% per loan, now, or 350 basis points. That's on a $100,000 loan. That's $3,500. Multiply it every time you go up another $100,000. There was money to be made during those times. The spread was great. Now we're finding that because of the way the world is and the tightening of the restrictions and the less money people are making on mortgages, because overhead is what it is in major lenders, whether it's Rocket or United Wholesale or Caliber or Nations Direct or, Fairway or Flagstar. There's all kinds of lenders out there who have staff and salary that they just can't cut to the bone. They have to maintain a certain level of staffing in order to be able to satisfy not only their investors, but also the market when it turns. So losing $82 a loan is not a good business model. Rocket is even having difficulty in order to be able to justify the amount of people they have working. Now, Rocket grew during the pandemic astronomically, and their particular way of growing was to hire staff, and their customer service is fine. It's really good. But they're having trouble. Now, if the biggest lender in the country, mortgage lender in the country, is having trouble, you can imagine the number of people out there in the mortgage industry, mortgage-related industry, who are also having trouble. This is part of the slowdown in our industry, which is trying to curb inflation. Inflation being what it is, about 8.5%. We're pretty soon, probably by the time you hear this, the inflation numbers will be out for October. I'm anticipating something along the lines of 8%, which it has been. We've been flat on that for about, 3-4 months. Energy being the biggest component of that and housing, rent, or purchase. All of these inflationary pressures keeps what we're doing, which means Fed raising rates and trying to kill demand. Okay, let's get right to some of the rates and what they are. The 30-year fixed rate is at 7.13%. The 15 years at 6.62. FHA is at 6.70. The jumbo loan is at 6.17, and the 5/1 ARM is at 6.82. The 2-year Treasury at 4.54%, and the 10 years at 4.063. Now that trend line for the 10 and the 2 have been that way probably now for about 8 weeks. And as we always remind everybody who's listening to the show, that has portended or has, in terms of future projections, shown that a recession is coming. I think a recession is coming. I think it's going to come the end of second quarter. Some people think it's already here. And with that number, that GDP number flirting between negative and positive over the last 3-4 months, it's really difficult to say. Some sectors are doing fine, some are not. But certainly, Fed raising interest rates once again, the short-term interest rates, really is pushing us towards not only a recession, but also to try to lessen the demand. If you've got to pay more for credit cards, you got to pay more for your car loan, yeah, that's going to quell your demand to go out there and buy other products. Consumers have really been resilient through this last 10 months, meaning that they continue to spend at the levels they had been spending. And I don't know whether that's a good thing, but we have seen credit card debt go up, and that's not a good thing. We'd rather see the savings rate go up. But when recession hits, that's when you see the savings rate go up. Like when COVID hit, we saw an astronomical number, about $1.5 to $2 trillion in savings, in addition to the savings that was already there during that 2.5 years of COVID. Okay, the buyers pull back, but actively looking. What does that mean? Well, that means that there's not as many, but the ones that are out there are still looking. One of the key components that we look at in the housing section of our economy is, are there buyers, are they still looking, and are they getting loans? By the way, the mortgage loan business is down 47% from what it was a year ago. The entire business, not just refi, well, refis are down about 85%, but refi and purchase down 43%. Let's see, the Fed speaks, yes, we talked about that, 75 basis points. We're probably going to look to another one at the end of December, too. Mortgage volume in 2022, half of the volume in 2021, half. So if we were at $4.5 trillion, we're about $2.25 trillion. Still a very healthy market, but nowhere near, which is why you see the layoffs in the business, which is why you see people with help wanted signs, not in that section, but in a lot of other sections you do see that. Let's see, break even at best. That's what the Mortgage Brokers Association has said about the mortgage industry. Q2 and 22, as I said, down $82 a loan per loan. Rebirth of ARM loans. Okay, a couple of the other products that are out there. Adjustable rate mortgages. We were happy to have people on talk about some of these products. Some of the non-traditional loans. No, the ARM product really got a bad rap during the 07-08 meltdown, probably because of the Neg-Am loan. There are no Neg-Am loans right now, but we do have ARM products. Rates are a little bit lower, right? And you can refi out of those pretty quickly, even though there is a prepay. Probably within 2-3 years, you can refi out, and that's when we're probably going to see rates come down anyway. We're up against it. I'm Jeff Barton, your voice in the mortgage industry. I really appreciate you all listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.